Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me, back by popular demand, J. Michael Oliver. Michael really has been around. He's been around the sun about as often as I have, so he's has a lot of experience, which is, I think, very important. Young folks out there, those of you who are listening, listen to your elders, because I think Michael has a lot of very important insights, not just from experience, but because of his own expertise and his own unique way of looking at markets, which I think makes him very valuable. He has quite a background, having worked at E.F. Hutton. Those older folks out there will remember that name. Younger people may not. But he's studied with some of the top people in technical analysis, has had a great background, has worked with, has had clients, has traveled and actually went to work on his own, and has had major household name clients in the past, and now he is also providing his expertise on a retail basis for, let's say, for accredited investors, people that are, have substantial portfolios, but people who can take advantage and trade off of Michael's expertise. So I'm really pleased to have Michael with me again. Before I say hello to Michael, though, I would like to suggest that you go to Oliver MSA. That's www.olivermsa.com for more information from Michael Oliver. Thank you for joining me today, Michael.
Thank you, Jay, for having me back.
It's really always good to talk to you, and I want to do this more often because I just really enjoy your missives. I think they are very insightful. But, interesting is one thing, making money is another. And I've seen how you can make money for people. I've watched your calls, and I think they're very sound. I liked especially the one, the China call last year, which I thought was just really superb. I mean, everybody was down on China about as hard as you could get, and your technical tools were telling you might start paying attention to it, and then sure enough, when you pulled the trigger, it did very, very well. So I don't know if we'll have time to talk about China today, but I would like to talk to you about some of the things that are really, really in the news these days, some of the markets that are really taking people, shaking them up a little bit, starting with oil. What are you seeing with oil? It looks like a falling knife to me, and you'd say, well, gee, oil at $48 today. I see this looks really cheap. Let's buy some, or let's go long on some of the oil stocks. And yet, we always say don't try to catch a falling knife. What do you see about oil now, and how soon do you think we might see the knife bounce off the table and we have a chance to possibly think about buying it again?
Well, I was very confident at $96 back in the summer when it came down from above 100. When it broke 96, it blew all of my momentum structures out. It said broke annual momentum, 200-week momentum, a lot of factors that I watch. Not short-term stuff, not trading stuff, but big grade technical signal. And so the collapse is sort of not surprising given that you've broken something major. And when you break something major that has been building for years, in this case these structures had been developing for 3 or 4 years under the oil market, you get a big response. I was intrigued last year and in late 2013 with a notion I threw out called contractionary event. And I was looking at gold, copper, and oil. And gold, of course, had its big contractionary event, but had a little effect on the stock market because, after all, gold, there's no big sector of gold within the S&P, for example. Mm-hmm. Copper also paid some heavy dues. It used to be $4.50 and dropped under $3. That's some dues paying. But oil hung in there. Mm-hmm. And I wondered why. And it dawned on me that the reason is, if you want to personify a market, oil is not going to break, was not going to break, until and unless the S&P was technically ready to feel the effects. And I think oil chose the time, starting this summer, especially in the last few months, where it's like a torpedo being fired at the equity market. My assumption was that it would affect the oil stocks and therefore drag the S&P down, but that really isn't what happened. What happened is the oil market affected the debt markets, the high-yield debt markets in particular, which is a trend that's been underway since January, where it's clear that investors are divesting themselves of what Bernanke wanted them to buy, namely high-yield risk-on debt. And oil has now punched a hole in that asset category, and those spreads are going crazy on the upside, meaning favoring government debt as opposed to emerging market bonds or corporate debt. And so that's a very dangerous situation for the equity market. So I think it's one step removed, but oil did the job. Mm-hmm. infected the debt market. The debt market torpedo is now headed to the equity markets. And I think that's what we're seeing. As far as an oil bottom, I'm not clear. I'm clear on one thing. The first low will not be the low. So if you make a low in oil at 45 and next thing you know you're 55, that was not the low. I'm 90% sure that any first low will fail. It will produce a rally, a tradable rally. But I do not think the final low will occur with the first low. I think it's a process that will take at least until the second quarter of this year before you can make what might be a lasting low. I don't know that it's a lot lower than we are now. Oil has done its job, I think, and I think by simply staying in a low price zone, it has its impact now on the debt markets. But you don't need to have oil continue to collapse. It's already collapsed to the levels that, if it stays here, will infect certain instruments that are based upon higher oil prices. And so that's all it really needs to do its job. But as far as buying oil, I have no interest. I might have interest in the second quarter after a first rally fails, and then we come back down. At that point, I'll start paying attention. But right now, I would not, other than on a trading basis, I would not buy oil.
So you don't. So there's virtually no chance of a V-shaped recovery here for oil, in which all these other markets you talk about might be saved. For example, there's going to be some real carnage, I would think, if oil stays in these levels. With with the frackers, with the marginal producers are going to be in big trouble, and those that have borrowed up to the hilt, we could really start to see sort of a chain reaction, perhaps, is what you're talking about, and what you think is going on in the equity markets now.
I think that's oil was the first torpedo, and I was mistaken as to back a year ago in my cause-effect relationship that oil would be the one that drags down the equity market because of the XLE, for example, the energy sector. It's not that. It's more complicated, and then it dawned on me earlier this year when earlier last year, when the debt spread started to move, that's where the torpedo was headed. And I think it's unavoidable now. I think it's in motion and it can't be stopped.
It's in motion and it can't be stopped. So let's just ask. Let's talk about the equity markets then. Recently, I think it was December 21st, in your letter, you said, and I quote, this sell-off had better stop very soon and very near. It needs to avoid 1940 to 1925. I don't know if I have these numbers written down right. And the bulls need to, one, halt the decline now, and two, more importantly, they need to get price back up over 2020 on the S&P and not look back again, not be at or below that price level during 2015. Well, we are. We were at 2,000 today, I noticed, a little under at one point. I don't know exactly. I'm looking at it right now. 2014, it says on the S&P at the moment.
We've done the damage, in my view. So rally today, tomorrow, it doesn't matter to me anymore. The structural damage has been done. The issue now from my point of view, my MSA's perspective, is the timing and the nature of the decline. I'm pretty sure where we're going, at least as a minimum target, and it's in the 1600s on the S&P 500, which is to say about 20% off the top. I think most developed market indexes will match that, either under a little bit less or a little bit more than what the S&P does. I think the two biggest culprits, and therefore the two biggest victims of this decline, will probably be blue chip U.S. stocks, that's the S&P 500, and the Nikkei 225. Europe, which is where most analysts focus on the economic weakness, I think Europe will actually be less weak in price terms, equity indexes, than will be the S&P. This is sort of contrarian to the economic view out there that, Europe is basically in a recession or flat, and we're not. But the technicals tell me the opposite's going to occur. Likely the S&P and the Nikkei, which are the two most, after all, if you think about it, they're the two most bloated blue chip indexes in the developed world, bloated by monetary policy. The JGB has done a Fed on us. In fact, they invented it. They invented the QE, and they have done a heck of a job of driving the Nikkei up. And I think that when the rubber band snaps, therefore the Nikkei and the S&P will give up more on a percent basis more rapidly than will Europe, which really, for instance, most of the European indexes were loitering either side of the 2011 highs.
Yeah.
That would be like S&P right now at 1,300 and something.
Yeah.
So I think it's a price issue there, that they have not been egregiously bid up, and we have.
Okay, Michael, what do you think then about the euro? What's your forecast for the euro?
The euro, I'm looking for the dollar. I turned bullish on in 2012 in the upper 70s dollar index. It's now got up to 91, and most of that was in the last 6 months. But I think the dollar is due for a corrective, congestive pullback. And I'm not looking for anything horrendous. We might be topping the dollar here, but it's not going to be a situation where you top and go down seriously. It will be a process that will extend out a couple of quarters. But the first phase of that is I think the dollar stands a good chance of stalling. Now, that would involve the dollar index, of course, is 57% the euro. So that's the heaviest weighted currency there. The yen is the second. I'm quite positive on the yen right now for a trade and possibly something even larger. And people might scratch their head and say, how can you have that view when they print so many yen, et cetera, et cetera? All I can say is when you measure currencies, you're always measuring relative, pardon the word, junk. Okay, so a currency can go up and not necessarily be solid. But the yen looks like it's overdue for a very strong rally. The euro, I think, I can't get very positive on it even on an intermediate basis, but I could say that I think that what I see in the dollar suggests that the euro could get some respite, some fumbling rally, some wasting time where it's not going down sharply, and therefore give the dollar its chance to pull back. And during that time, I think the yen is the place to look, and that is a very disruptive currency if it rallies, by the way.
Yeah. You mean in terms of the global markets? Yeah.
Yes, absolutely.
Yeah, well, that'd be fascinating too. I mean, not unnerving perhaps too, but in any event, the dollar. You mentioned the dollar. I noticed that you like to look at pairs. You like to look at spreads, and one very interesting spread that you've talked a lot about is U.S. Treasuries to high yield bonds, TLT to HYG, for example, two ETFs that you use, and I've actually decided to use that in my newsletter portfolio. I'm using TLT and another junk bond ETF. But do you think that's a good trade going forward at this point in time yet?
I think it's going to go up. I think the TLT will continue to outperform the high yield. In other words, you'll continue to have money move out of the high yield assets and into TLT, into government debt. So it's not like money is fleeing the debt markets. It's not. It's just moving from one side to the other. And it's actually not just a spread gain of TLT versus HYG. It's a net price thing. TLT is going up and HYG is going down. So the spread is working because both aspects of the spread are going in the proper direction. I think there's more to come there. It could be dramatic. But it's not the kind of thing I can suggest to somebody because the move has already been very big.
Oh, yeah, of course. And that's why that's why I was wondering if you think there's still some more to come, but maybe look, I'll be watching your work to determine when we might want to get out of there and take some profits, I suppose.
Well, I think the better play on that right now is actually short the equity markets because I think they have a lagged effect to that spread.
And very good. Okay.
The dragon's tail hasn't swung yet, and the best gains are short the S&P because of that spread.
Okay, very good. Well, we only have a couple of minutes left here, and we've got to touch on gold. I mentioned gold and the dollar seem to be correlated positively now for a change, and at least since around Christmas. But you put out something here recently on gold and the S&P 500. Clearly, since about the start of this year, the first couple of trading days, we've seen a dramatic switch. The equity market's getting hammered extremely hard, and gold showing quite a bit of strength actually here. How are you looking at this going forward now? Is this a new trend, do you think?
I think it's about to become one. I think it's almost destined the way when I look at the long-term spread relationship between gold and the S&P. Remember, gold beat the pants off the S&P for 10 years.
Right.
11 years almost. If you own gold and were short the S&P from 2000 to 2011, you made gobs of money. We've had a big drop in the spread, but it looks to be a big corrective drop. Now, if gold right now, if you divide the price of gold into the price of the S&P and express the result as a percent, you'll find it's just above 60% right now, gold to S&P. If that closes weeklies, monthlies out above about 63 to 64%, somewhere in that zone, that is a breakout, and that tells me that the asset category shift is underway again, favoring gold, disfavoring equities. And I don't mean for a few weeks. I'm talking about something that looks like it could last for a couple of years. It looks major, and it looks near.
So
therefore, I think that spread says a lot.
So a return to the secular bull market in gold, perhaps. So don't know if you look at it in those terms or not, but certainly I've looked at it as if we've never been out of the secular bull market. We've taken quite a correction here in a cyclical bear, but in any event, we'll see. But that's why your work is so interesting. And I might mention, I mean, you don't have a set time of publication. You put out things when you see something very important. You put it out to your subscribers.
That's right. It's on average at least a report or two per day.
Oh, I know. You're prolific. You work extremely hard for your subscribers, and I would think that accredited investors, people who who have a fair amount of money to invest, might want to take advantage of your service now that you're making it available not just to large institutions but also to investors. So it's OliverMSA.com. Oliver. OLIVER, M as in Mary, S as in Sam, A as in Albert.com. Anything else, Michael, before we conclude our discussion today?
I think we're approaching the potential for very fast markets, where a lot of it that I see cooking here could come uncorked very quickly. In other words, a very strong up move in gold, a very sharp down move in the S&P, and not something that's dragged out. I could see the S&P under the right circumstances dropping 20% within weeks. And the numbers are not far. In fact, just below today's low, I had some numbers. And if we get to, I'll give you the number, it's 1988 S&P. If you trade that number, as far as I'm concerned, it's white knuckle flight.
Wow. Okay, well, fascinating stuff. The sparks could be flying here. They are certainly flying early already in 2015. I want to thank you very much, Michael, for being with us again, and we look to do it again sometime in the near future. Thank you so much.